You may have heard the saying, don't put all your eggs in one basket. Know that the same thinking can be applied to your investments. Diversification is a widely regarded investment strategy that aims to achieve investment goals while minimizing risk. By spreading risk across multiple investments with different characteristics, your successful investments should ideally outweigh your not so successful investments. Welcome to the From Zero to Wealth channel. If you're new here, this channel provides you easy to understand information about wealth creation through personal finance and investing, teaching you what schools should have. And if you're returning, welcome back. This video aims to show the value of diversification and how you can incorporate it into your investing strategy. There are a few key takeaways from this video. 1. Investing can be an effective way to build long-term wealth and unlock financial freedom. 2. Investments can be spread across multiple asset classes, geographies, currencies, and maturities. 3. Exposures to investments risk can't be completely eliminated, but it can be reduced through an investment strategy called diversification. 4. Investors can achieve diversification by creating a portfolio of investments that react differently to global events and market turbulence. 5. Risk and return are the main drivers of diversification, but there isn't one approach to diversifying a portfolio because investors have different risk appetites and expectations for returns. Diversification is an investment strategy that aims to spread risk across multiple asset classes. The goal is to build a portfolio of investments that will react differently to the same changes in the market. Since all investments come with the risk of losing the money you invested, diversification is a way of reducing your exposure to the risk associated with one particular investment by spreading your capital across multiple investments. This means holding several investments over different assets, geographies, currencies, maturities, and other differentiating factors. Diversification is intended to make sure that no single part of your portfolio carries the entire burden of a win or lose situation in the event of one or more investments failing. The more varied your portfolio is, the less you'll feel the impact of circumstantial events on the individual parts when you look at it as a whole. It's important to understand why it's such a necessary tool for investing. All investments come with the risk of losing the invested money. By investing in many different assets, investors can mitigate their exposure to individual investments failing. Each investment will only make up a small part of the portfolio, and losses in one area might be offset by gains in another, especially if the individual assets are less correlated. So while investment risk can never be completely eliminated, diversification is widely regarded as a key tool for reducing investment risk and earning consistent returns. Perhaps you're thinking, so why not just make the right investments every time? Even for the most experienced investors, it's barely impossible to make the right investments all the time. It's the nature of investments. You can only speculate and then hope for the best. As Warren Buffett said, diversification is protection against ignorance. In other words, none of us have the ability to see into the future and know the upcoming value of their investments for certain. Therefore, diversification is your safety net against the unforeseen. By the very nature of investment, correlation means that some asset classes will move in accordance with or in opposition to other investment classes. If you look at traditional assets, stocks and bonds perform differently under market pressure. When the economy is doing well, the value of stocks may rise, with a clear opportunity for profit. There are two main types of risk that affect investments: systematic risk, also known as market risk, and unsystematic risk. Systematic risk are those which affect an entire market. For example, political factors, recessions, pandemics, and fluctuating interest or exchange rates. Unsystematic risk relates to risk faced by individual companies, such as new competitors entering the market, business continuity, and compliance or financial issues. While diversification is an effective way of reducing unsystematic risk, systematic risk is generally unavoidable since it's brought on by existing economic conditions and is outside the control of businesses. A diversified investment portfolio makes sure no single investment is responsible for the portfolio's performance. This strategy aims to have the higher performing investments outweigh the lower performing investments, so even if some make a loss, you are more likely to average out an overall profit from the remaining investments. For example, if you were to invest 100% of your money in volatile stocks, the level of risk would be quite high, but the expected returns could also be high. However, let's say you decided to change your portfolio so that it consisted of 50% stocks and 50% bonds. Bonds are typically lower in risk than volatile stocks, but also lower in terms of expected returns. By adding in a lower risk asset class, such as bonds, the overall risk of your portfolio has now been reduced. This is because the risk and return variables of the stocks, high risk, high return, and bonds, low risk, low return, average out when you consider the overall success of the portfolio as a whole. So in other words, the portfolio with both stocks and bonds has lower risk compared to a portfolio made up of just volatile stocks, and a greater chance of earning profitable returns overall. This is the basic principle of diversification. Risk exposure can never be completely eliminated, but it can be reduced, and diversification provides investors with a way to do this. The more diversified your portfolio is, the more the overall risk is reduced with expected returns. There is no one-size-fits-all approach to creating a diversification strategy, because it can be achieved in a variety of different ways. However, a general guideline is to choose investments with different variables, such as different asset classes, geographies, currencies, and maturities. One way is diversification across asset classes. An investment portfolio can be diversified by investing in more than one asset class. An asset class represents a group of investments with similar characteristics. For example, stocks, real estate, bonds, and loans. Each asset class is subject to different factors that determine whether they perform well as investments, such as liquidity, volatility in the market, stability of returns, and inflation. For instance, if there were a drop in demand for cars, it would likely affect the stocks of car companies, but less likely to affect uncorrelated assets such as real estate. Another way to diversify your portfolio is by diversification across geographies and currencies. Investments that are part of the same asset class can be diversified by geography and currency. Countries have different characteristics, both good and bad, and each has an economy influenced by its own decision. Political instability, economic crashes, and pandemics are just a few factors that can pose risk to the outcome of an investment. The COVID-19 outbreak, the financial crash of 2008, and Brexit are all examples from recent years to show why investing across different geographies matters so much. By spreading your investments out across the world, your portfolio is best protected against unexpected global events. Also, investing across different geographies can also work to your advantage if one region is doing particularly well economically, such as a small country with an up-and-coming economic power. By incorporating geographical diversification into an investment portfolio, you reduce overall exposure to these countries' specific risk. With currency diversification, you reduce the risk associated with exchange rates having an effect on your entire portfolio at the same time. Furthermore, by having investments in more than one country, you increase the opportunity for more returns, as multiple countries may provide good returns at the same time. The length of time investors are willing to commit to investments is also important, as the risk and returns associated with short-term and long-term investments may be different. An investment portfolio can also be diversified by having a range of different maturities. Short-term investments are often characterized as being riskier but can provide higher returns. This is because they are not around for long enough to wait out any correction in the market if there's a significant spike or drop. Longer-term investments, such as real estate, typically provide slower, steadier returns because they are less affected by sharp changes in the market. So while it can be beneficial to have a range of maturities within a portfolio, a long-term approach to investing overall will ensure you can meet your investment goal with lower risk. Diversification aims to reduce overall risk, but as every investor has different risk and return expectations, there isn't just one way to diversify a portfolio. So there are different ways for investors to achieve diversification based on their risk appetite. Risk appetite is the amount of risk that you are prepared to bear. This is influenced by many factors, one of the biggest of which is age. Younger people usually have a higher risk tolerance than someone in middle or near retirement age. They can invest in riskier but high return ventures, knowing that they have the time to offset potential risk over time. Similarly, personal liabilities such as a high number of dependents, personal expenses or debts can also lower your risk appetite. Understanding your risk appetite is the first step in diversification of risk. People with a high risk appetite will be willing to undertake risky ventures for higher returns. On the other hand, conservative investors will prefer lower volatility. Most people are moderate investors, falling somewhere in between. Diversification means less overall risk. Expected returns are the motivation behind investment decisions, but the risk associated with investing are why diversification is important. Regardless of your risk appetite, by having a diversified portfolio with different variables, you can reduce overall risk and increase the chances of achieving your expected returns. We hope you find this video helpful and understand why diversification is important. If so, like this video, subscribe to the channel for more videos and turn your bell notification on to get notified when new videos are uploaded. Thank you for watching and we'll see you in our next video.